Well, hey there, everyone. Happy Monday, February 23rd. My name is Dave Keller with Market Misbehavior, and welcome to Chart This with Dave Keller, our daily market recap show. We're coming to you from a not snowy Redmond, Washington, and I say that with, well wishes and safe wishes to all of my friends in the Northeast. Sounds like a banger of a nor'easter. We lived in the Boston area for almost 9 years in Scituate, Massachusetts, which was often featured on the Weather Channel during days like this. You'd lose power for at times a couple days to over a week. Mountains of snow, feet of snow you'd be buried under. So my heart goes out to all of you kind of struggling with that snow. We're against snow in the Pacific Northwest here, and it's pretty calm and chill here, kind of a normal winter day. So I hope you guys are all doing well wherever you're at. Great picture, a lot of great pictures from the Northeast. One that stood out to me on Bloomberg was a picture of the Wall Street Bull covered in snow, which is like this mountain of snow. I mean, what a perfect visual for this particular trading day as the markets go risk off. AI fears, hangover from the tariff announcements over the weekend. I've heard it attributed to a number of things, but definitely felt like a sort of tech and financials kind of led decline here as the S&P and the NASDAQ both down just over 1%. Small caps even worse, volatility increasing, safe havens like gold and silver doing well, speculative plays like Bitcoin not doing well. A lot of ugly charts in the financial sector. We've been talking about financials getting less awesome. As a matter of fact, on a show last week, we talked about a line in the sand for the XLF. That line in the sand was triggered today. So today we're going to talk about this risk-off move for equities. We're going to talk about the declining breadth conditions. We're going to try our best to separate what was an ugly day for stocks versus some of the broader implications, focusing on key levels to watch for all of these charts. As always, can't thank you guys enough for tuning in, for telling your friends about the show, for asking great questions. We had an awesome mailbag episode on Friday, by the way. If you missed it, please go back and check it out. It was a great one, featuring questions from all of you guys over the last week. So keep them coming. The comment section on our YouTube channel is the best place to drop questions for us, and we appreciate it. Let's take some time here. We will talk about the market conditions here on Monday, February 23rd, with a rough start to the week, I would say. And this is going into obviously some pretty serious earnings this week, particularly NVIDIA. And, I was wondering if Monday, Tuesday would be sort of a, calm before the storm. Not very calm today. And that's what some news headlines can do is cause the market to rupture a little more quickly. We'll talk about the sentiment going into or coming out of today's session. Look at the heat map. The market carpet's a lot of red today, but we'll focus on some of the areas that were not down as much as the major averages. And then I've hand selected some charts. Key theme today, when in doubt, zoom out. So I've got some weekly charts to share with you to help make sense of some of the daily charts. All right, so here's what happened in the S&P. It was a weak open, right? We opened and we dropped, and for the first 90 minutes of trading, it was pretty ugly. The S&P eventually made a low around 11:15 Eastern, right around 68.20, chopped around through the remainder of the day, but that's down quite a bit from finishing the week over 6,900. If you remember last week, Friday's strong session kind of put the short-term market model back bullish for us, kind of saved what had been a pretty rough week. But today, kind of right back to the feel of the markets before Friday's more constructive session. Today's drop was enough for the S&P to close down 1% to 68.37 and change. The NASDAQ Composite down about the same. The Dow down 1.7% to 48,800. Mid caps, small caps all going down. The S&P 600 small cap index, the worst, down over 2% today. That downturn was enough for the VIX to move up about 2 full points. So we finished the week just above 19. We finished the day just above 21. So we're back in that red flag region with the VIX above 20. Elevated volatility, basically means days like this are more to be expected. So the VIX remaining above 20 here this week would be a pretty negative sign for risk assets. Big warning sign here today. Bonds definitely rallied here today. The TLT was up just about 1/3%, not a huge day. And you can see that the yield curve kind of drifted lower here. The 10-year point's getting very close to 4%. We're not too far away from that. So we finished around 4.03%. The long bond yield now just below 3.7%. So we've seen rates drift down here as bonds start to rally. Dollar index ended up opening lower, but rallied into the close and ended up being unchanged for the day. Comment here is obviously we're going into the next Fed meeting, right? I mean, that's the next sort of big signal to watch for in terms of interest rate policy, but that's another month out, right? That's mid-March is the next meeting. Market pricing in essentially no change to the Fed target rate. Market really not pricing in any sort of change until the June meeting, right? Which is mid-June. So that's basically suggesting March, April meetings, no change. And again, that's what the Fed funds futures are telling us as of today. We'll see what happens as the week progresses. But basically, this implies no lowering of rates for now. We'll see if that would evolve here, but rates definitely coming down. Looking at the commodity space, gold up 2.7%. That's the GLD, the SLV, the silver ETF finished at the highs of the day, up over 5%. So that we talk about those charts. I charted the GLD, which I grabbed for you. Sort of big exponential run higher, kind of a big swift pullback, then kind of a consolidation phase. And it certainly looks in the last week like that chart's resolving to the upside. And I think that's pretty compelling. Crude oil prices essentially flat here, although they've been trending higher along with gold and silver. Natural gas relatively weak here. So generally commodities pretty good. Cryptocurrencies back in the bright red here. Bitcoin spent the weekend, especially Sunday, getting up over 68,000. But as the equity markets opened, we accelerated to the downside. We got as low as 64,000. We did bounce here in the last hour or so, up to around 65,000. But that's still down about 4%. Ethereum prices down almost 5%. The rest of the top 10 coins in the red today. So big risk off move, generally speaking here. Looking at the 11 S&P sectors, we can see, actually more mixed, right? Kind of 5 up, 5 down, and 1 flat in the middle. On the upside, it's the defensive sectors, consumer staples up 1.25%, healthcare up 1.1%, utilities up 0.8%. On the downside, big way on this market, financials down 3.4%. Consumer discretionary down 2.1%, and the XLK technology down 1.7%. Problem is there's a lot of market cap represented in those particular sectors, a lot less market cap in the sectors that are up today. So even though the sectors were kind of split, half up, half down, the bigger sectors were the ones that were generally down here. A lot of the growthy sectors, financials as well, and that's weighing on the major averages pretty good. Obviously, big, takeaway from today, consumer staples up 1.25%, consumer discretionary down over 2%. This is that classic measure of offense versus defense, something I picked up on from my Fidelity predecessors. Bill Doan, who ran the team in the 70s, used to track ratios looking at offense versus defense. And I started looking at the XLY versus the XLP and the equal weighted versions of those ETFs as well. We've got that chart here in a little bit, but day like today shows you defense, right? Consumer staples outperforming offense, consumer discretionary. This implies that investors are rotating to more defensive positioning within the consumer space. Consumer discretionary, way more economically sensitive, way more dependent on consumer sentiment and confidence. Consumer staples, a little less sensitive to economic changes, kind of consistent things you're always going to spend money on. So those things doing well and the consumer discretionary doing poorly. That's not a good read. Those ratios made new swing lows here today. Looking at the breadth data, it wasn't good today. And that's been one of the differences when I think about what's new, right? What did we learn today? The breadth starting to turn a little more negative, right? The long-term breadth measures are still good, right? Well over half of the S&P 500 members are above their 50-day, well over half still above their 200-day. So we haven't had breakdowns to the degree that it feels like this is a broad decline. However, what we've been noting is that the benchmarks have been essentially flat. but the breadth measures have been remarkably strong. And so that's what has saved this market. That's what allowed the S&P to be sideways for so long now, is the fact that it's like the Mag 7 names, the leading growth names that are down, but a bunch of other things in industrials and materials and consumer staples and energy doing so well, that the breadth was remaining quite strong. So it sort of said the benchmarks are flat because there's the big growth names that are down, but there's a bunch of other things that are up, and strong breadth sort of confirms that scenario. So that resolves in one of two ways. And the way you don't want it to resolve is that the weakness in AI related names is so weak that instead of people rotating to defensive positioning or rotating to value oriented sectors, they just rotate out and they start panicking, right? When you panic, you don't kind of calmly and rationally reallocate to industrials, right? You just panic sell and you go into some sort of safe haven. And so weaker breadth conditions with a market sell-off this week would be a pretty dangerous combination. For today, it looks like the New York Composite Index, almost a 3-to-1 ratio of decliners versus advancers. You had 73% of that exchange down today. On the S&P, about a 2-to-1 ratio, a 65% decliners. The worst numbers were in the small and mid cap space. In the small cap space, almost a 4-to-1 ratio. 78% down to 21% up today. So big distribution, a lot of things down. There were some random things that are up, and I promise you we'll try to highlight those when we get to the market carpet. Looking at the Magnificent Seven and Friends, these are those leading growth names that I was talking about. Look at the bottom of the list. Now, Netflix has been a dog of a chart for a while now, so not that concerned about Netflix being down another 3.4%. It's been down a lot going into today. Microsoft is one of those leading names struggling to hold support and now just doing this classic breakdown thing where you break below support, you retest the breakdown level, you make another leg lower. And that's, I would argue, what we're seeing here today. Down over 3%. Again, I did grab that chart to show you. Also the weekly chart to zoom out a bit. Tesla down 2.9%, Meta down 2.8%, Amazon down 2.3%. And with those particular names, these are names that have been in a short-term distribution phase. And the question is, when does a short-term sell-off become a long-term, more significant sell-off? And I would say those charts are at varying degrees of approaching that really important level where you really need to find some stability. Otherwise, I think you just have to openly declare that those are really bad charts, like Netflix already is, like Microsoft already is. Some of these other ones are starting to look a lot more like those really beaten down stocks. Let's celebrate the two of these that were actually not down today. Apple, which has not been a particularly great chart, up 0.6%. That's good to see. NVIDIA, which is arguably creating this huge topping pattern, but has not broken support yet, holding and up about 0.9%. So those are two kind of bright spots to highlight. All right. If you like the color red, you're going to love the heat map here in a moment. As I do so, please remember, if you have questions on any of the charts we're about to show you or that we have shown you so far, please take a moment, drop a comment on our YouTube channel. We really appreciate your feedback on the show. Very much appreciate your questions. Friday's mailbag was a lot of fun, and those shows are fun and interesting just because of the quality of the questions you guys are all asking. And I can't tell you how much I appreciate it. So please take a moment and ask a question in the comments section on our YouTube channel. We'd love to hear from you. So what's refreshing about this heat map, if there is something to be, I'm an optimist, as much as you may not think so, because I generally have more of a cautious tone. Even when things are good, I'm always looking for things that are not good. And that just comes from my experiences as an investor, being skeptical of uptrends and just always thinking as a contrarian as much as possible. That's what I was trained to do. So that's what I keep doing. So given the fact that we've been in this great bull market for a while, you may feel that I'm more of a bear. In life, I'm an eternal optimist. I really am, and I usually expect the best in people, and I'm pretty optimistic. Everything's going to be okay. So with that in mind, let's start with the good stuff, right? What worked today, right? On a day when the benchmarks were down, on the day when the breadth was ugly, is there anything to be excited about? And I think that's one of the great takeaways from looking at the heat map on a day like today. It's very easy to get caught up in the headlines, which was the AI trade is down. Financials got clobbered. Big consumer struggled. But there are a bunch of things that actually did just fine today, right? And look at the sectors on this heat map that are mostly green, right? It's in some of the defensive sectors like healthcare. where have you guys been, right? Healthcare has been not a great sector here so far in 2026 after having some strength. And there are names like Merck that were kind of the outliers because they were so good. A lot of these other names have been struggling a bit. Like Stryker comes to mind, right? SYK. Look at this breaking back above the 200-day moving average after struggling to regain that for a while. It's a medical equipment name. That those are the kind of impressive kind of breakouts that I'm seeing here. Edwards Life Sciences, right? EW, which had been below the 200-day moving average today, regaining the 200-day, right? So with these kind of charts, when you get below the 200-day moving average, that puts it on a on a not good list. That puts it on the red list for me, the underweight list, because it tells me that unless we can hold the 200-day moving average, there's just not a lot to get excited about. Getting back above the 200-day is something to be celebrated. That's when you usually get some, often get some really nice recoveries when we're below the 200 and finally regain it. No guarantee. You can have false breakouts for sure, but I've been trained to recognize when a stock has been below the 200-day and then finally regains it, and that's something to just watch for and see if there's signs of further accumulation. So I think there's charts like that within the healthcare sector that are worth noting. Look at consumer staples today. This has been kind of off, a number of people's lists here recently because other sectors have been improving a little more strongly. We look at PG making a new 3-month high today. Philip Morris not quite making a new all-time high, but getting back there. Walmart was coming off a new all-time high last week and sort of dropped going into the weekend, but that's close to making a new 52-week high. So I'm seeing some of these names really start to recover here. Not everything, but I'm seeing some new 3-month highs, and I'm seeing some improving charts within the consumer staples sector. Other one I would notice would be utilities, right? One of the more defensive sectors. You can see with the other ones, I mean, just a number of things kind of doing okay. But utilities, real estate, these are two fairly defensive sectors. I mean, those are doing well. Just tells you that investors are owning those because they probably don't want to own other things. Another market tell that I've learned with the new, it's not that new anymore, but remember, communication services was a new sector. This has been probably 10 years now, so I shouldn't say a new sector anymore, but I still think of it as the new sector because it used to be the telecom sector, and that was basically AT&T and Verizon and a bunch of smaller names, and it was this tiny little sector. And then communication services, it was some consumer names, it was some technology names, it was some old telecom names, all kind of put into this new communication services sector. But it really is kind of a mixed bag of different stocks just within the S&P 500 names. And so the defensive part of the sector are the old school telecoms like AT&T and Verizon, right? These are the mobile names, sort of the landline names. Some media names in here like Comcast, Disney, Warner Brothers, and it's the defensive areas of communication services doing quite well. The internet kind of names are struggling today. AT&T and Verizon both up today, so that's another kind of tell looking there. The other thing I would say in terms of bright spots, obviously the two biggest technology names weren't down today, and being up less than 1% isn't a huge up day, but on a day when the benchmarks looked as bad as they did, I think that's encouraging to note technology stocks that did not go down along with the major averages and along with the rest of the sector. All right, so that's the good news. What's bad? So I would say the financial sector and the technology sector and the consumer discretionary sector. I'll probably throw industrials. Those are, and communication services. There's 5 sectors. So from the top here, financials, obviously the biggest, sort of broad decline was in the financial sector. These charts are in varying degrees from not good to really not good. And I would say I grabbed a couple charts and I forget which ones, but I remember I brought one of the big banks like Bank of America or Morgan Stanley. I forget which one I ended up grabbing. Those obviously, just classic topping patterns, making lower highs, breaking down through key moving average support. I think that's a concern. The payment processors like Visa and MasterCard are both struggling here quite a bit. And it gets further down, right? Some of the regional banks, which had been some of the more encouraging areas, assuming a more normal shaped yield curve. Now all of a sudden we have bonds rallying, we have the yield curve flattening, and the regional banks are all getting dinged. Look at Synchrony Financial, SYF. Look at the new all-time high in the first week of January. And then from there, it's just been trending lower. Today, we're closing below the 200-day moving average. which has not happened in quite some time. We're right around some key support around $67, $68 a share, but we are threatening, and I don't like the fact that we broke below the 200-day moving average there. So I would argue financials, I mean, just looking less and less like a sector that looks particularly constructive here. Within the technology sector, obviously a lot of names in a big time decline. IBM was in the news along with others. I mean, just part of this general idea that AI is going to destroy these businesses in some way, or that the promise is not going to be as encouraging. IBM is down 13+%, but you can see other names within the technology sector all getting dinged here pretty well. So our general take, right? If you've been following our work, we've been charting, and if you followed my webcast last week, this was literally the topic of the webcast was, the general rotation from growth to value, from value to defensive. And I feel like today's session sort of encapsulates a lot of the risks that we talk about, which is, AI related names generally struggle. Where do assets go? They had been going to industrials and materials and healthcare at one point. The danger is we get into some of the, sort of bear market leadership names, right? Utilities, consumer staples, real estate. So we're starting off the week with those sectors looking the strongest on a relative basis and simply being up today. So this definitely felt like a rotation from offense to defense on this particular trading day. A lot of game left through the course of this week. And again, NVIDIA's earnings could be key. I mean, that could change the whole complexion of this market very, very quickly. That's sort of observations on what we're happening here. Again, this is more of the same in terms of the rotation, but a friendly reminder. I always say it's always a good time to own good charts. Focus on the charts that are working. Lean on the technical analysis toolkit. Remember that there are charts like McDonald's out there, even when it looks like the world's ending. MCD is a pretty good chart right about now, right? So look for strong technical configurations with good price action, with strong momentum, with improving relative strength. They're out there. We just have to keep identifying them. All right, we're going to continue on in a moment. I'm happy to highlight some of the platforms that I use in my own process, and I do want to mention Koyfin. Appreciate a great partnership with Koyfin over time, supporting the channel. You can go to marketmisbehavior.com/Koyfin to learn more about one of the tools that I use every day. I was actually just using it earlier today, doing a webcast later this week for some Italian investors. And so Koyfin has great international stock coverage, good mix of technical criteria, which is very important to me, to some basic fundamental criteria, right? I'm not a fundamental analyst, but I know some basic valuation things that I might want to consider. I know some things about earnings growth that I might want to consider. I know some things about debt that I might want to avoid. And so incorporating some of those basic building blocks into screens has been quite helpful. I also use it often for ETF holdings, which is remarkably valuable when I want to look at an index or an ETF like the XLK or the XLY or the XLF and understand what are the biggest stocks in those ETFs and how they're doing. Can be very, very helpful. You can find more info at marketmisbehavior.com/Koyfin, Koyfin, or scan the QR code that you see on your screen. Shall we look at some charts together? So what's funny is even with this day, so number one, we're nowhere near 7,000 on a day like today. So continue to it's again, the worst thing I did for the market. You can if this ends up being the top, you can blame me later for threatening to play my horn on the air if the S&P closed above 7,000, because that's pretty much been the top since I started making that declaration end of last year. And so here we are, still well below 7,000, but today pushing back below Friday's open. And I think that's an important just kind of 2-day pattern. This really isn't an official candle pattern to speak of, but I would say Friday, right? Tuesday, Wednesday, Thursday. Remember, last week was a holiday week because Monday was the President's Day holiday. So in the U.S., we had Tuesday, Wednesday, Thursday, which were kind of choppy below the 50-day. And then Friday comes along with this big higher close. We close near the highs of the week. Certainly felt like this that could be the beginning of some big recovery. So the fact that we opened lower today, but then closed down at Monday's low, basically Friday's optimism erased by Monday's, pessimism. And here we are kind of right back where we were, Tuesday of last week, languishing between the 50 and 200-day moving averages, holding the recent swing lows just below 6,800, but not really getting any sort of momentum to the upside. So we're back below the 50-day. We are back, we remain in a sideways consolidation phase. We've been talking about short-term 6,800. If we can hold that, we're still okay. We break 6,800. We're going to talk about some downside objectives and more, how to sort of track a potential, market topping pattern if it would emerge. But first things first, and we sold off today, but we're still above that sort of initial line in the sand. We sold off today, but the momentum is still neutral, right? The RSI is still well above 40. So the RSI has been between 40 and 60 pretty much entirely since, the end of November and for the most part since the end of October. So we still have neutral trend. We have neutral momentum. We're going to be watching that lower end. Today's sell-off just basically puts that support level around 6,800 back into play. The momentum, any break below the RSI of 40, I think would be a big danger sign. We'll have to just continue to watch to see if and when that might occur. Next chart, and again, breadth really not changing a ton in the short-term breadth. The McClellan oscillator may have dipped below zero today. I don't have that updated data to share it with you, but that's something we'll look at in the morning or later today. So breadth, but generally breadth is still going to be okay, particularly the long-term breadth readings. What's also okay is the action in gold and silver. I'm showing you the GLD because we've talked about this chart a number of times here. And as a reminder, we had this big acceleration. We had the significant sell-off going into the beginning of February. And then we sort of stalled out a bit. And now it certainly looks like Friday, again, pretty encouraging rally. Even though stocks rallied, gold rally did well. And today, stocks sell off, gold kind of bounces to the upside. So seems like that has regained its mojo. Precious metals, I would argue, back in a primary uptrend at this point. Bitcoin remains in a primary downtrend. This is the risk to this pattern we talked about. We sort of talked about the chart of Bitcoin, and I don't have the lines drawn on here for some reason, but I'll quickly do so, right? So we're kind of talking about it's not a perfect pattern, but just this kind of general kind of, consolidation. You had the big spike down, the bounce higher, and then we kind of settled into this consolidation of lower highs and higher lows. Now we've broken below that to the downside. So I would say that is a sort of downside resolution. The momentum has been negative for Bitcoin. That's down here at the bottom. Look up, the RSI has been below 40 since the end of January. So we're just very much in a distribution phase according to the price action and according to the momentum. But today's drop appears to resolve this pattern to the downside and suggests we're not done with the deterioration. The great unwind of cryptocurrencies from a technical perspective does not appear to be over yet. Offense over defense, these ratios are making a new 3-month low today. And, while the S&P and the NASDAQ dropped, I think the more concerning rotation is here, because one of the things that we could not say until January and really into February was that defensive sectors were doing well, right? The major benchmarks were holding their ground. We just hadn't seen a big move into defensive sectors. Now we're really starting to see that. And today's just more of that rotation. Here's the ratio of offense to defense. So we have the consumer discretionary versus consumer staples sector, or as I like to say, things you want versus things you need. When this ratio is trending downwards, as they both have, cap weighted and the top equal weighted versions in the bottom, both those ratios have been in a slow and steady decline so far year to date in 2026. Out of all the charts I would analyze for you as part of my normal routine, this is the one that has had the most significant shift, I would argue, from pretty bullish in December to very much not bullish in January and February. That's been the biggest shift, is this rotation to more defensive leadership. Let's look at some individual stocks here and dig in a little further. By the way, if you missed our webcast where we talked about that rotation in a lot more detail, you can still access the replay at marketmisbehavior.com/calm, CALM, as in the calm before the storm. We talked about the market benchmarks being sideways, but a lot of rotation underneath the hood. Please do yourself a favor and watch that webcast while it's still available for you. If you're a Market Misbehavior Premium member, which you can find more info at marketmisbehavior.com/premium, you will have access to all of those webcasts as long as you're a member. So you can check it out there. But non-members, you've only got the rest of February to check it out. But you can still access it at marketmisbehavior.com/calm. Let's finish off looking at some individual names. I've been a little too verbose, so I'm going to go rapid fire through some of these. Microsoft is a bad chart, full stop. And I would say that is an unbiased technical opinion. Now, what makes it a bad chart? Again, I think the amateur version of technical analysis is to look at a chart like this and say it's a bad chart, which it is. But what makes it a bad chart? This is what we want to do as an investor using technical analysis. Get from the amateurish kind of gut reaction kind of analysis to more of a thoughtful, intentional evaluation of market conditions, right? What about this chart makes it an ugly chart? In terms of trend, we're making lower highs and lower lows. In terms of support levels, they've not been holding, right? This is a Fibonacci framework using the major low and major high of 2025. We can then look forward past this double top pattern and note how the stock bounced off the 38.2% level in November and December and early January, bounced off the 50% level in mid-January, broke right through the 61.8% level at the end of January, bounced up to retest that level from below. So literally this Fibonacci framework, we have hit each of these levels and failed. And again, look at this, how we break below and then retest it from below. And that is the nail in the coffin for any sort of optimism, I would say, from a technical perspective. So we're making lower lows and lower highs. From a technical perspective, the April lows are now in play. That's around 341 on an adjusted basis. The momentum is ugly. The relative strength is bad. You bring in more data, and this the mailbag episode on Friday, we had a question about the someone had posted on social media a downside objective around 335, and I just want to show you. So today's breakdown, I think, is related to that chart we talked about, and my answer was, yeah, that's a reasonable downside objective if you take a longer term time frame. So if you go back to fourth quarter of 2022 as the low, and then the 2025 high as the peak, 61.8% of the way down is right around 339. That actually lines up pretty well with the April 2025 market low. That's a reasonable downside objective. We saw this level on the daily chart, but when you bring in the weekly chart, you look at the longer term structure, you see this is actually a confluence of support from a couple different approaches. By the way, sorry if my voice is a little hoarse. We went to the Seattle Sounders home opener last night, a thrilling victory for the guys in Emerald Green, winning 2-0 over the Colorado Rapids. But I was screaming pretty hard for Paul Rothrock and the other Sounders, so apologies for that. Doing okay though. SanDisk in a good chart and in a good pattern, and I think it's important when the news headlines are technology sells off. When we see the Nasdaq's rolling over, charts like JBL are still good charts. Charts like SanDisk, SNDK are still good charts. This is a daily chart of SanDisk just to show that there are charts out there in sectors like technology and growth sectors that are still remarkably strong charts. So I'm a fan of not writing off an entire sector just because of a general theme. Does that, is it reasonable to like under allocate or like, not be, making aggressive bets in technology? For sure, right? If I'm doing like a sector rotation play, I probably would not have technology in there at this particular moment because of the weakness there. But there are individual stocks within the technology sector that still look really good. As I sign off every episode of the show, it's always a good time to own good charts. So make sure you just have a good process of identifying those good charts. I would say something like SNDK above an upward sloping 21-day EMA, moving averages all going up, momentum strong but not excessive, relative strength good, still a great chart. So they're out there, right? Tell you what is not a good chart is the XLF. We talked last week about identifying some key levels of support. 51 was the level that I had identified because that's the low from August of last year and November of last year. The 200-day had been broken. So the question was, well, as long as we hold 51, it's still maybe an okay chart. It's not anymore, right? We closed below it. We'll see tomorrow if we get some nice counter trend rally, right? Follow through is important. So we'll see if we follow through to the downside. But for now, the financial sector breaking that level of support and the XLF making a new 52-week low on a relative basis. Let's look at some of the individual stocks within that sector a little more clearly. Morgan Stanley, a lot of the big banks kind of look like this. Look at how well MS had respected an ascending 50-day moving average all during this ascent, all the way until earlier this month. Then we break down, we rally, we fail to regain the 50-day. Now we're going lower. The RSI is right at that point where it's breaking below 40. So a clear change in character, I would say, on this chart with no real signs of bottoming just yet. The payment processors like Visa and MasterCard all getting hit today pretty good. MasterCard's down another 5.8%. Similar, potential bottoming pattern, potential bullish momentum divergence, but today's drop really erases that new 52-week low on a relative basis. The weekly chart of MasterCard, when in doubt, zoom out. We bring in a lot more data, similar to what we talked about earlier with whatever that was, Microsoft. Here with MasterCard, we can take the 2022 low around 270, the 2025 high around $600 a share. That's all using adjusted data. 38.2% of the way down is right around 475. The 150-week moving average is right about there. The March-April swing low from 2025 is right there, kind of right at that point where if MasterCard's going to find a low, we're at that point where it should happen. And if it doesn't, that's where I think you really probably want to be out of the way. Akamai Technologies, here's your candle quiz of the day. I randomly find one of these, and I just want to make sure. I feel like if we do this enough, you're going to have all these cold. What is this two-candle pattern? We went down. We had a big down day, lower open, close did not engulf the previous day, but it did close at least 50% of the way up. If this happened, if the opposite happened, right? If we had a big up day and then a big down day that closed at least 50% down, it's called a dark cloud cover candle. We've highlighted those on the show, but when it happens like this, it's called a bullish piercing line. For me, candle names like that are good, just so we have a vernacular, we have a language that we can use to describe these. But what's more important to me is to recognize there's a big down day and then a big up day, and that two candle reversal right at the 50-day moving average implies the next 1 to 3 bars more likely bullish than bearish. I don't know how I did that. Bullish than bearish for the chart of Akamai Technologies. Sorry, I completely destroyed this great thing. That's it. That's the last chart. I was going to say, I think the last one was that candle quiz. That'll do it. Folks, thanks so much for joining me here on the show. Thanks for following me and my work. And thank you, as always, for your thoughtful questions on our YouTube channel. Take a moment, if you could, like the video, drop a question in the comments section. What stands out to you? What tickers have we not covered on the show that you'd like us to? Any technical indicators or market themes or anything else that you'd like us to dig into a little further? Now's the time to ask that question. In the meantime, I will say have a fantastic evening. Those of you in the Northeast, good luck with the weather. Enjoy the snow. Please be safe and hang in there. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.